than the market has anticipated, and that is indicated by more and more officials saying that we may see a rate rise this year. Well, if they stick to the sequencing, which they choose to do, they may change that and say, well, we may raise interest rates whilst we still have an asset purchase program running. That may be a more sensible way to play it. But at the moment, they're sticking to the sequence. And if you stick to that sequence and you have this big buyer going away, which is really, the ECB put, then we may see more volatility going forward. And it then depends clearly on the political situation in Italy and all those things. But the knee-jerk reaction by the market generally is, this price-sensitive buyer isn't there. We don't have the backstop by the ECB, so, yield to widen.
All right. Thank you so much for joining us, Tatiana Grail-Castro, Muzinich Portfolio Manager and Co-Head of Public Markets. Appreciate your insight. Now, coming up, we'll turn back to geopolitics and the crisis over Ukraine. Russia says it's pulling back some of its forces, but the West remains skeptical. We'll discuss with Jana Puglierin of the Council of Foreign Relations next. This is Bloomberg.
Earnings season continues.
The Metaverse to Spotify to Qualcomm and beyond.
Bloomberg is fastest with the numbers and analysis.
Peloton becoming a proxy for this pandemic.
I think there's a tremendous opportunity.
Bloomberg, the fastest numbers and analysis you trust.
So let's get back to one of our big developing stories over the last few days, the crisis in and around Ukraine. Russia has announced that more troops are returning to their bases after maneuvers ended in Crimea. But Western officials remain extremely cautious. They are looking to verify. The NATO Secretary General Jens Stoltenberg says at this point there is no proof of de-escalation.
We are, of course, ready to engage in dialogue with Russia to seek a political, diplomatic solution, but we are also prepared for the worst. And therefore, I'm grateful for the U.S. increased presence in Europe with more troops in the eastern part of the alliance. I also welcome the increased readiness of 8,500 U.S. troops ready to support the NATO response force.
Let's get some analysis on what is happening here. Jana Puglierin, Senior Policy Fellow at the European Council on Foreign Relations, joining us now from Berlin. Jana, the NATO Secretary General is actually briefing reporters right now, and we're seeing some headlines coming through from it, talking about the idea that Russian coercion is, quote, and these are his words, the new normal. Is that your view as well? Is this a situation that Vladimir Putin, the Russian president, is going to be happy with? The instability that we're seeing in Europe, is this something that he is going to want to persist with and therefore maybe doesn't want to bring the current situation to a head?
That is what I believe, actually. I think it is an illusion to believe that we can go back to some sort of status quo, a stable status quo with Russia. First, because there was no stable status quo prior to the recent troop buildup in eastern Ukraine. There is a war going on since 2014 with 13,000 deaths so far. And second, because I think it's very much in the Kremlin's interest to keep the situation unstable and not to find a lasting solution to settle the conflict.
Well, can there not be a lasting solution so long as the Biden administration doesn't cave to Vladimir Putin's demand that Ukraine not be able to join NATO? If that doesn't happen, how can there be a resolution?
Yeah, you're absolutely right. As long as the West is not giving in, some sort of Finlandization of Ukraine, closing NATO's door, the conflict will prevail, because fundamentally what Russia demands is not acceptable, nor to NATO, nor to the United States, or even to Germany. I mean, this idea to find an agreement with Russia is very difficult because the West has insisted on fundamental principles which Russia doesn't want to respect, and there is no common ground.
So where does that leave Minsk, particularly Minsk II, and the idea that we could have elections, who would control those elections remains obviously key here. I'm trying to understand kind of where the current diplomatic efforts therefore go next. The European powers are putting a lot of kind of emphasis on Minsk II, hoping that that will provide some sort of a vehicle for progress here.
Yeah. Especially the German government, together with the French government, tries to give a new spin to the Normandy format debates. Russia was not at all interested in the format for a long while. There were no meetings, and now Russia is interested in it because I think the hope is that Germany and France would put pressure on Ukraine, basically to accept that the independence of Donetsk and Luhansk, the kind of the regions in the east, what Russia wants. Russia wants control over Kiev through those regions. But that is not our interest. So our interest is to get Minsk implemented, but that means also that Russia needs to withdraw all its troops. And it's all about sequencing. The Ukrainian side says Russia needs to do this first, whereas Russia insists that, the status of Luhansk and Donetsk needs to be changed first. So it's a dead end, but Germany and France try to revive it, nevertheless.
When we think about what Russia wants, Jana, to what degree has there been blowback by the actions Vladimir Putin has taken so far, in that it has reinvigorated the NATO alliance, brought a lot of these players, back to the table, meeting with each other, meeting in Moscow, putting more troops in Europe on the part of the U.S.? I mean, doesn't that run counter to what Vladimir Putin ultimately wants?
Yes, I think that is very interesting. So, I remember the days when we talked about NATO's brain dead and discussed whether the alliance had a future, and now it's like giving NATO a new life through Putin's actions and giving it a new or a renewed course. But I think the problem is that we are in for the long game here, and what Russia could count on is that the West might get distracted pretty soon because there will be other conflicts. We will develop some sort of Ukraine fatigue, and our attention will shift. And so I think what the Kremlin counts on is really that this is going to be a long conflict, and in the end, the West might lose interest in supporting Ukraine because it's so costly, because it's so toxic, it's so dangerous, and all these problems come with it. But I think in the short term, NATO definitely is back, and the United States and Europe.
I think people have been writing off NATO since the fall of the Cold War, and that organisation may be seeking a purpose. I was certainly writing essays at university on that very subject a long time ago. Jana, where does China fit into this? Where does Taiwan fit into this? Do you think Beijing is watching the Western response here and rethinking, recalculating its attitude towards Taiwan?
Absolutely. I think there is an emerging alliance between Russia and China. And I think this meeting between Putin and Xi was very telling. The language that comes out of Beijing is now completely different than after the annexation of Crimea in 2014, much more to the Kremlin's advantage. So I think we really need to watch this alliance closely, and the nightmare, a Western nightmare, would be kind of an attack on Ukraine and a simultaneous attack on Taiwan, which would put the United States under a lot of pressure. You had two fronts, basically. And that is the nightmare scenario, which we need to avoid. I think we are not there yet because China is not ready with regard to Taiwan, but still, I think this alliance is very dangerous.
All right, Jana Pugliaeren of the European Council on Foreign Relations, thank you so much for your insight. And speaking of nightmares, we're going to tell you a story involving mysterious payments, one of the world's most notorious terror organizations, and the Swedish telecom equipment maker, Ericsson. Those details next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Mariska Gupta. The CEO of Volkswagen warned of more output cuts because of the chip crisis at its main factory in Wolfsburg. Herbert Diess said VW has made progress managing the global components bottleneck, but he said the situation remains challenging. The Wolfsburg plant is the world's largest, and there have been tensions over the shift to making battery-powered cars. Bloomberg's learned that Germany's national railway operator Deutsche Bahn is preparing to sell or list its DB Schenker Logistics unit. A deal could be valued at about $23 billion. Like other transport and logistics firms, the Schenker unit has gained in value during the pandemic. And JP Morgan Chase has a lounge in the metaverse. Visitors are greeted by a digital portrait of CEO Jamie Dimon and a roaming tiger. The lounge is located in Decentraland, a browser-based metaverse backed by the digital currency group. It was set up by JP Morgan's blockchain unit. The bank just released a paper on how businesses can explore the metaverse. And that is your latest Business Flash. Guy.
A roaming tiger. It's always a nice touch. Britika, thank you very much indeed. Shares in Ericsson under quite a lot of pressure today, in fact falling by the most since July of 2017. The reason for this, the Swedish telecom equipment maker made a startling admission overnight. It may have made payments to the terror group ISIS. Basically it did so, we understand, so that it could make logistics and operational sort of changes that it needed in places like in Iraq. Basically transportation logistics. Let's talk more about this. Matt Bloxham of Bloomberg Intelligence joins us now on set. Matt, I just want to take a step back and talk a little bit about where Ericsson is coming to this from. It is coming to this from a DOJ investigation that caused it quite significant pain in the past, and the DOJ is concerned that it hasn't even fulfilled its obligations around the settlement that it had with the DOJ, and this related to other payments that were made in other areas. Is this new? Can you just put this in context for me and how investors should be looking at this?
Yeah, sure. So we don't know for sure, but it certainly looks like it's new. As you mentioned, the DOJ settlement back in 2019, which Ericsson agreed to pay $1 billion against, called out 5 countries, and Iraq wasn't one of those countries. So it looks perhaps that prompted some additional kind of soul searching on the part of Ericsson. Maybe they knew about things. I think the CEO said that these payments hadn't reached a certain threshold of materiality, so they perceived not to be that important within Ericsson. So I think it does seem like it's new, and I think the issue for them will be that if the DOJ feels like they've withheld information as part of a historic ongoing investigation, that could create serious future consequences for Ericsson's business in the US and potentially further.
Okay, so what would those consequences be? Are we talking another large fine? Is this criminal? Will heads roll? I mean, what could that ultimately look like?
Yeah, well, I mean, based on the previous settlement, that was criminal, so that there could be a fine. That fine was $1 billion. We'll have to see what happens with this one, but that gives you a kind of sense of the scale we're talking about. Potentially you could see Ericsson, excluded from, providing equipment to US operations. I mean, the US is about 1/3 of their revenue. I mean, we're speculating right now, but these implications could be quite serious for the company.
What specifically do we know about what these payments were for?
Well, I mean, I guess we don't know very much, but I mean, I guess the
company's not saying very much.
No,
right?
But I guess reading between the lines, are essentially facilitation payments, if you like, to kind of see the smooth passage of equipment through Iraq, to get equipment to places it needed to get to create new mobile base stations, for example, through areas controlled by ISIS.
Matt, we'll leave it there. Thanks for the update. Really appreciate it. Matt Bloxham of Bloomberg Intelligence on what is happening with Ericsson. Quick look at what we are looking at when it comes to European equity markets as we head towards the close of trading here this Wednesday, the 16th of February. European equities started off fairly strongly. We've subsequently faded since then. As you can see, most of the main markets are tracking a little bit lower. Yesterday was energy that was under pressure. It was the basic resources sectors that was under pressure, as a result of which London underperformed. Today, just at the margin, and it's only at the margin, London slightly outperforming. I'd say it's basically firmly within the middle of the pack in terms of the performance that we're seeing here. We'll deal with the details in just a moment. The close is coming up. This is Bloomberg. So we're wrapping up the session here this Wednesday in Europe. Started off quite strongly. We've been fading since then. You can see as the map tells you the story. FTSE 100's off, CAC's off, DAX is off. The IBEX actually in Spain is in positive territory. The FTSE MIB in Milan is flat. But broadly, European equities started off very strongly and then have been basically fading throughout the rest of the day. Don't take it from me. Let me take a look at the next chart, which will basically show you the session of the Stock 600, and you can see the kind of performance picture that we've seen. An initial move higher and basically a fade throughout most of the rest of the day. The last 2 days have been very tight ranges after an initial move. Today feels a little bit similar, but maybe with more of a downward trajectory. We're off the lows, but as I say, we're flirting with the flat line, 467. We are only up by less than 0.1% on the Stock 600. In terms of what we're watching with other asset classes, because actually this is where life gets interesting, take a look at what's happening with the UK two-year yield. Very strong inflation data out a little bit earlier on, but not maybe strong enough to convince the bank to go by 50 at the next meeting. The Bank of England I'm talking about here. March meeting, starting to be priced in that direction, but the Bank of England, certainly the governor, talking about gradualism. So we've seen a big move lower in terms of the front end of the curve. Brent has been bid today. That's interesting in terms of the flip that we're seeing in terms of the sector story here, and actually some stabilization in the move around the dollar. So what does that mean in terms of the sector narrative? Well, let's talk about that right now. Single stocks have actually had a fairly significant impact in terms of what we're seeing here, but up at the top, it's been a return of the commodity trade. Real estate's up, but energy's also up and basic resources are up. So the energy stocks and the miners have had a good day after being beaten up yesterday. Bottom end of the market, this is where life gets interesting. So the grocery sector down by 1.26%. There's a lot of Ahold in there. I'll talk about what's happening with Ahold Delhaize in just a moment. Telecoms also lower. We were just talking about Ericsson. It's weighing heavily on that sector. So let's talk about the single stocks and show you what is happening here. Ericsson down by 14.41%. We were just talking about Bloxham, about the investigation when it comes to ISIS. That is certainly weighing heavily on the stock, sub 100, trading 99. Ahold Delhaize, actually Ahold Delhaize and Heineken are two really interesting stories. They're both talking about inflation. They're both talking about the impact on the consumer. Ahold in the grocery sector which is on both sides of the Atlantic. It's got businesses on both sides of the Atlantic. Ahold talking about the supply chain issues that we're talking about, continue to talk about the fact that there's very little sign of their easing significantly, but also just the inflation impact on the consumer. So Ahold tracking quite lower on the back of that outlook. Heineken in the beer business up by 1.95%. Not giving us much guidance today, talking about the idea that inflation is going to have an impact on people's decision making. You've also got the extra effect here as well of maybe a new normal in terms of people's behavior. A lot of people, and we've been hearing over the last hour about countries wishing to remove all restrictions when it comes to COVID, but maybe there's a lasting legacy, and maybe the entree, people eating and drinking in restaurants and bars, doesn't come back maybe as quickly as anticipated. But nevertheless, the numbers broadly from Heineken solid today, the stock up by 2%. Now the company's CEO was talking about all of this on Bloomberg Television a little earlier. Let's take a listen to that.
The absolute input cost increase we tried to pass on in pricing, as we've been able to do in the second half of last year. So this is not new for this year. It actually already was happening in the Q4 of last year. Again, we were able to get the pricing and the volumes remained resilient. A lot of the pricing for 22 is already locked in. The negotiations with major retailers are advancing well. We're not the only ones. Everybody's facing the kind of same input cost pressure.
So Guy, we've been talking about this Heineken story a lot today. You and I both have a nice cold frosty one on the brain, I think, because of that. But it does raise a question. I mean, you and I, we like our beer. Disagree maybe on what types we prefer. I'm a Stella Artois girl, Guy. I know that you are not. But how tolerant are we going to be? How much are we willing to pay as prices continually climb? I think that is a question not just for Heineken and the beverage industry, the food industry broadly, but retail across the board. And it is a question that maybe was borne out a little bit in U.S. retail sales today as well. Demand's still strong even in the face of inflation.
Well, just come back to the beer business, because I think as you say, we're both quite interested in what is happening here. There's been a huge premiumization of this business over the last few years. They basically tried to take the price point higher and higher and higher. You get the kind of the halo effect. It may be a stretch to talk about this when it comes to beer, but maybe the higher price value business, higher price value good actually makes you think that it is worth more. And that's been basically the objective here. But as people start getting hit with bills left, right and centre that are going up, maybe they trade down a little bit. Maybe you don't go for some of those premium beers. Yeah. I know this is heresy, but maybe there are different choices out there.
Maybe I downgrade from a Stella to a Bud Light guy. I don't know how you'd feel about that one. Let's talk more about these inflationary pressures. And ultimately, pricing power is the name of the game for these companies. Karim Shedid, BlackRock's head of investment strategy for iShares EMEA, is joining us now. If we're thinking about pricing power and the companies that have it and those that don't, where would you want to put your money? What sectors?
Yeah, we've been looking a lot at this concept of pricing power, focusing on companies that are able to withstand the inflationary pressures that potentially lead to higher input costs and put pressure on some of their margins. Here we're looking at companies in the tech sector that have good cash on balance sheet, good ROE and balance sheet fundamentals, and are able to retain their pricing power. So they're able to pass on some of those extra costs to consumers without hurting the consumer demand. And also some of these global brands, strong global brands within luxury but also beyond the luxury sector that are able to withstand that.
I'm really curious what you say about tech, which is interesting because the market often views tech as being a long duration business. Rates go up. You don't want to necessarily own that because you're discounting future cash flow. But what you're saying is that they probably have better pricing power than others. How do I put those two things together and how does it net out?
It's really a relative trade, as you say. So when I think about the equity view here, we need to think about barbelling in our portfolio. So focusing on some of these exposures that do well when rates are going up, looking at sectors like financials and exposures like value, but also focusing on the companies on the other side of the quality barbell tech, despite the headwind from tightening. And it is, the caveat here is that there's a lot of hawkishness already priced in the market. So despite that, focusing on those names in technology and quality that can do well because of their ability not to hurt consumer demand, their ability to defend their margins.
Okay, so that's on the sector level. What about on a regional level? We saw with the Bank of America Fund Managers Survey, which Guy was pointing out to me earlier, people starting to turn away from Europe a little bit. Are you?
Actually, when we look at Europe, and here I'm speaking about European equities, we've started to see a pickup from ETF flows tilting towards European equities as of the start of the year. And that trend has really continued even in February. So here I'm looking at exposures within the European equity space, like Eurozone equities, so Europe ex-UK benchmarks, but I'm also looking at financial sector exposures within Europe. And that tilt, when we think about Europe's positioning with regards to how much is priced in for the ECB and as well how Europe is doing in the earnings season that's wrapping up over the next couple of weeks, I think that tilt from investors that we're seeing in ETF flows could continue, could have legs.
People are looking for hedges. They're trying to figure out how they deal with the inflation narrative that looks like it could become embedded for at least a while. We're seeing money moving into commodities and other areas. Certainly into the rates market, we're looking at floating loans and what is a much better place to be from a protection point of view when interest rates are potentially rising. But let's just focus a little bit on the commodity story. In terms of the flows that you're seeing, is there any sign that they're slowing down, picking up? Is that hedging process accelerating, decelerating? I'm wondering kind of where we are, how much further or not we have to go in this process?
Yeah, I would really break up that commodity space into two areas where we're seeing interesting trends. The first is really looking at the energy side of things and industrial metals, and the second is really looking at precious metals.
Yep.
Within the first bucket, we have seen some pickup in flows in energy exposures, which is to be expected given the moves that we've seen in the oil price. And energy producers have really lagged relative to oil prices, so they could continue to pick up from there. On the precious metals side, gold ETPs have started just now, in the past couple of weeks, pick up some demand. It's very nascent, it's very early to call whether that has trends to continue, the gold space. But what is interesting is gold producers, so gold equities, which have so far lagged. And whilst we started to see the first move in gold ETCs, we could start to see that translate into the gold equity sector.
So while we're talking about what we're hedging, obviously inflation is one that people are looking for. What about geopolitical risk, Karim? How do you view that?
I think, of course, the geopolitical risk that we're seeing in markets at the moment does present some challenges in the near term. But when we zoom out, I think a couple of things. First of all, these types of geopolitical events can cause market gyrations and market volatility in the near term, but don't tend to have a very lasting impact on markets when not altering fundamentals. So the other area is really going back to the gold conversation that we just had. I think this is one of the drivers. The geopolitical risks are one of the drivers why we've started to see some pickup in those gold exposures.
Karim, thanks very much indeed for coming to see us. Really appreciate you making it into the studio and joining us in person. Always appreciate that. Karim Chedid, the head of investment strategy for iShares EMEA over at BlackRock. Quick look at the final numbers here in Europe. This is what we look like. We have, as you can see, moved very little as we've come through the final auction process. A little tick lower, but not very much. 76.03. We've been in and around that 76 area for the FTSE 100 for a little while. But European stocks starting stronger, fading into the last hour of trading before a little bit of a pickup off the earlier lows. But nevertheless, a negative session, albeit only just for European stocks today. At least the FTSE, the DAX and the CAC. We'll carry on the coverage of what is happening here in Europe, both the geopolitical story and the inflation narrative. We'll do that on the cable show at 5 p.m. here in London, 12 p.m. in New York. We're live on DAB digital radio on all of your Bloomberg devices, and you can also catch the podcast on Spotify and Apple. Kaylee.
Well, and no doubt you'll be talking about that UK inflation guy, and something that has contributed to inflation, supply chain bottlenecks. And one company is a crucial link in that supply chain, and it's coming off of a big fourth quarter. We'll talk with the Chief Investment Officer of GXO, Mark Manduca. This is Bloomberg.
So just before Christmas, I had the opportunity to go up to the Midlands here in the UK and see one of the most automated logistics plants there is out there. It's run by GXO for Nestle. It was an incredible experience and it gave me an idea of which direction this industry is heading in. The company had a bumper holiday season, beating fourth quarter estimates, its e-commerce revenue soaring, and it's raised its outlook for the year. Joining us now, GXO's Chief Investment Officer, Mark Manduca. Mark, you've raised the EBITDA forecast. You're feeling very positive about this business. How sustainable is the trajectory that you're currently on?
Guy, thanks for the opportunity today. This is secular growth in its finest form. As you said, a record of quarters here. But be very clear, there are three secular tailwinds driving our business. E-commerce, which is barely 20% penetrated across our North American and European markets. Outsourcing, which is barely 30% penetrated. And as much as we're leading the way in automation, automation in warehouses is barely 5% automated. So we are literally in the first innings of this story. There is massive, massive growth ahead for this business.
So what does that indicate about when supply chain bottlenecks are going to normalize, Mark? We hear a lot from different people in the C-suite of industries across the board. They think the second half will be better. Will it?
I mean, we're really a company for all seasons. We benefit in supply chain panics. We benefit in supply chain clearances. We're a business that does well in all scenarios, I feel. But to answer your question explicitly, the supply chains are going to remain, to a certain degree, stuck in the mud for the first half of this year. I think we'll see early signs of the air freight market correcting itself. I think we'll see the container shipping market correcting itself in the second half of the year. But the one thing that's not going to change is inflation. I see it persisting till at least 2023 and possibly 2024. That's one of the persistent themes that I think you're going to see over the next 12 to 24 months.
This is being talked about on a lot of calls right now, Mark. Companies talking about the fact that their margins are under pressure because the cost of getting goods to consumers continues to remain elevated. You're saying you don't see that coming down anytime soon. In terms of what that is going to mean for your customers' margins, what do you think they're looking at? What do you think you're looking at?
So there's a couple of things about the way our business works. So to your first point, inflation here to stay. We're seeing double-digit growth in inflation in some parts of the US market, and we're seeing mid to high single-digit growth in some parts of our European business. So inflation is still tracking high, and like I said, it's here to persist. In terms of thinking about the inflation element of how our business operates, we're really an inflation hedge. I love what you said earlier, Guy, with my friend Kareem, about thinking about inflation hedges in the market. We're a real asset providing real consumer goods, and we do pass our inflation on to our customers. It's almost like they're running the warehouse, albeit we are an advisor for them. That's the way of thinking about our business. They pass the customer costs on. It's their choice of whether they then pass it on to the end consumer. And as you were mentioning in the earlier segment, clearly the consumer right now is getting a lot of that cost passed on.
Well, and in terms of how these businesses are navigating inflation and using you to do so, is the answer increasingly just automation?
One of the things of the outputs of inflation, I couldn't agree more. We're seeing automation across so many different rungs of our business. Demands from customers who want to have robotic arms, they want to have vision technology, automated gantries. Guy saw it at our Nestle facility over up in Derby back at the Christmas peak season. It was a phenomenal period of growth for us from an automation standpoint. It makes up 30% of our business right now. And as I mentioned, the market's only 5% automated, so lots and lots of growth ahead.
Still need trucks, still need truck drivers. Mark, that remains a problem. What are you seeing on the labour front? And obviously we're looking at what's happening between Canada and the United States, the bridge being blocked. Truck shortages remain a key issue. How are you dealing with that right now?
There's two parts to that answer. I think in terms of the inflation point, we're going to see these sporadic uprisings continue through the course of 2022. I think to that point as well, as our business really is focused on 900 warehouses across 27 countries and 1,050 customers, we're tilted away from that trucking market. But it's an important part for our customers, and therefore we care in terms of providing solutions. What are we seeing? Well, I think systematically, I think we're going to see better improvements coming in terms of people dealing with their labor forces. I think they're going to have to work very hard at making sure that they have the right competitive wages in the market. People have to do a better job from an HR perspective. And I think, to the earlier point, there's going to be more automation coming of people working alongside robots, not people working against robots. And that's going to be the real theme going forwards. But inflation's here to stay, and I think we will continue to see strikes throughout the course of 2022 across a number of different businesses in the value chain.
In terms of what happens with growth going forward, what we're trying to work out now is whether inflation, higher interest rates ultimately leads the consumer being hit and hit hard. As you say, it's a choice as to whether or not these cost increases ultimately get passed on, be it higher trucking wages, higher diesel costs, all kinds of factors coming into the mix. Mark, as you look forward and you talk about the fact that you're in a secular growth period, what do you see as the sort of the growth narrative around that, the economic growth picture that you are going to be operating in? You talk about being a business for all seasons. What do you see in front of you in terms of the growth that is going to be there at a macro level?
So we're looking for those shadows in the night, but we're not seeing them yet. We talked last time about how there were 4-hour queues outside of Gucci. Those stories are still anecdotally persisting through our business. We're not seeing a slowdown in either the brick and mortar side or the e-com side. We've just posted e-com growth of some 45% on a far tougher comp